I looked into the economy this week, and honestly, I wish I hadn't. Most people think the economic threat in 2026 is inflation, or tariffs, or maybe a housing slowdown. Those are real, but they are not the thing that should keep you up at night. The common belief is that if the stock market is up and unemployment is relatively stable, everything is basically fine. That is what they told us in 2006. That is what they told us in 1999. Here's the contrarian reality. Right now, three separate fault lines are cracking at the same time, and almost nobody is talking about all three together. I spent the last week going deep on the data, the economists' warnings, and the historical patterns. What I found genuinely shocked me. By the end of this video, you will understand exactly what those three threats are, why each one alone is dangerous, and why all three happening simultaneously is the scenario that serious economists are quietly terrified of. I've covered economic trends for years. This is the most concerned I've been. Start here, because this one will stun you. According to analysts, the AI bubble is already 17 times the size of the dot-com frenzy and 4 times the size of the housing bubble. Let that land for a second. 4 times the size of the bubble that wiped out millions of families in 2008. Here's the specific mechanic that makes this dangerous. Total AI capital expenditures in the U.S. are projected to exceed $500 billion in 2026 and 2027, roughly the annual GDP of Singapore. But American consumers spend only $12 billion a year on AI services. That gap between what is being spent and what is being earned is not a gap, it is a canyon. AI companies are using accounting tricks to depress their reported infrastructure spending, which inflates their profits. The big AI firms are also shifting huge amounts of spending off their books into special-purpose vehicles that disguise the true cost of the AI build-out. This is the same financial engineering that preceded the 2008 collapse. Different product, identical playbook. To justify their investments, the industry will need to generate roughly $2 trillion in annual revenue by 2030. In 2025, the industry generated $20 billion, about 1% of what they'll need in 4 years just to break even. Why does this matter to you personally? Because if the AI bubble were to pop, the fallout would cause widespread economic damage due to what Apollo's chief economist calls a single point of failure. The S&P 500 has transformed into a concentrated bet on artificial intelligence, your pension, your 401k, your savings, all riding on one trade. That alone would be enough to worry about, but here's what makes 2026 different from every previous bubble scare. There's a second fault line cracking right underneath the first one. This is the one the government is not saying out loud. One chief economist pointed to long-term sales declines and sluggish construction activity in concluding that the housing sector had already slipped into its own recession, not heading toward one, already in one. Here's the psychology of why this is so dangerous. The housing market does not crash loudly, it freezes. Buyers and sellers have been reluctant to make moves as interest rates remain elevated, mortgage loan rates slowly tick down, there's a lack of affordable inventory, and reports of rising foreclosures signal homeowners are continuing to get squeezed. A frozen housing market is actually more destructive than a crashing one because it locks people in place. Workers cannot move to where jobs are, families cannot downsize, capital cannot flow, the entire economy becomes arthritic. Legendary forecaster Gary Shilling, the man who accurately predicted the 1969-70 recession and was fired from Merrill Lynch, now warns that a U.S. recession is almost inevitable by year-end, driven by the frozen housing market, collapsing corporate investment, and a weakening consumer base. And this connects directly to the third fault line, which is the one hitting ordinary people hardest right now, today, in their actual lives. The first two threats are structural. This next one is personal, and it's already happening to people who have no idea it's happening to them. The U.S. economy runs on consumer spending, roughly 70% of GDP, which means the moment ordinary people stop buying, everything downstream breaks. The Fed's upgraded GDP growth forecast for 2026 is 2.3%, but the unemployment rate has risen to 4.4% and core inflation remains sticky at 3% annually. What that combination produces is something economists call stagflation light, growth that looks acceptable on paper while the average person feels like they are falling behind every single month. The share of small businesses anticipating revenue growth dropped to its lowest level since 2020, and expectations for employment growth sank to multi-year lows. Small businesses are not macro forecasters, they're people watching their own registers. When they get this pessimistic, they're telling you something the quarterly reports are not. 4 key threats could redale the economy in 2026: policy-driven inflation, stagflation light, consumer exhaustion, and the potential AI bubble. And while none of these are necessarily recession triggers on their own, they could compound into something more serious if they collide. That word collide is the one that matters. Any single fault line is manageable. All 3 cracking simultaneously, feeding into each other, that's how cascades begin. The dot-com bubble alone did not cause a decade of pain. It was the dot-com bubble plus corporate fraud plus loose monetary policy all converging at once. What we're looking at right now rhymes with that pattern in ways that should make every informed person pay attention. So let's zoom out. You came into this video thinking the economy is facing the usual mix of uncertainty, maybe some tariff tension, maybe inflation still lingering in the background, maybe just short-term volatility that will eventually settle down. That's the surface-level story most people hear every day. But when you zoom out and actually look at what's happening underneath, the picture becomes more layered and in some ways more serious than expected. One of the biggest forces right now is the rapid expansion of AI-related investment. Some analysts compare it to a bubble-like cycle, potentially around 17 times larger than the dot-com era in terms of capital flow and market exposure. The core concern isn't just excitement around new technology, it's the mismatch between massive expectations and unclear long-term revenue generation. When trillions of dollars are deployed ahead of proven returns, even small shifts in sentiment can create large ripple effects across markets. At the same time, the housing market is showing signs of deep stagnation. On the surface, prices in many areas still look stable or even elevated, but beneath that, activity is slowing sharply. Transaction volumes are down, affordability is at historic pressure points, and mobility in the economy is freezing. When people can't afford to move, upgrade, or relocate, the housing market stops acting as a driver of growth and starts acting like a brake on the system. Then there's the consumer. For years, spending has held up stronger than many expected, but that strength is starting to look more stretched. Prices remain sticky, debt levels are rising, and the job market is showing early signs of softening in certain sectors. This doesn't appear as a dramatic collapse, it appears as gradual fatigue in purchasing power, where households slowly lose flexibility. None of this means a crash is guaranteed. Economic forecasts are deeply divided. For example, Treasury Secretary Scott Bessent has expressed strong optimism about 2026, suggesting that current policy conditions may support a period of stable, non-inflationary growth. That perspective is credible and reflects a genuine belief that the system can stabilize. But optimism alone does not eliminate structural risk, because the real issue isn't just what people think will happen, it's how systems behave when pressure builds. Liquidity shifts, credit tightens, sentiment turns faster than fundamentals, and small weaknesses in multiple areas can combine into larger macro effects. What matters most is not picking a side between optimism and pessimism, it's understanding the mechanics underneath both narratives. And that gap between the simple story most people expect and the more complex reality beneath it is exactly why this conversation matters more than it first appears. Watch this again if you need to. Share it with someone who thinks everything is fine. And if you want to go deeper on exactly how to position yourself when these 3 forces collide, that is the next video.